Let's start off with really my rules. I keep a little book with me, and it really talks about each market and how I'm going to approach it. And I'm constantly really tweaking this. I wouldn't say constant. It's not happening on a day-to-day basis. It's happening really on a month-by-month, year-over-year basis. But there are some simple things in here that when I look at the E-mini NASDAQ that I'm very conscious of when I come in and step in and look at the day. The first thing I want to talk about is market environment. There are only three environments that I look for to short the NASDAQ. That's either mean reversion, which I talk about a lot here. We're going to show you what that looks like. That is a market environment. Range expansion lower, or I look for shorts in NASDAQ in consolidation periods. That's it. I never, ever look at shorts, consider shorts in range expansion higher, especially in the NASDAQ, right? If there's any market that I do not even consider it, it would be this one. I think you've all probably gotten a really decent education even if you're new to trading futures, how much that NASDAQ can go in one direction, especially higher. So it's one of those things where you got to be very careful of fading it. And that's why I want to focus on this today. Other notes that I have, and it's similar in all of these markets that I follow, multiple confirmations. One of the keys is when you're looking at a market that you're trying to short. And I think that when you're trying to short futures, because one of the things that's great about futures is the ease of access of being short, but it's also, I think, a detriment to a lot of new traders because you can come in and get short and you're going against really the grain. The markets overall are meant to go higher, whether you want to believe that or not. When I started, the S&P was at 600. It's at 40 something hundred. I wish I just bought the S&P and held it, but that's a different story, a different show. But ultimately, they're meant to go higher. So anytime you're looking at short, one thing I'm always really conscious of is multiple confirmations. Make sure that that short is showing me more than one look, right? Not just jumping in at resistance. Quick on, quick off with trailers. That's something that I look at in the NASDAQ, especially because with NASDAQ, I try to spread them out a little bit, my offers. And then when I get in, I try to rotate out of it as soon as possible, get a trailer on, and then try to just, work my stop and let that thing run if it can, right? It's very hard for me to sit in a very large position in the NASDAQ, especially in some of these market conditions, because most likely they're going to shake me out and trigger my stop, right? I mean, the slippage is so much greater in the NASDAQ than it is in the S&P. Price is not as important. So therefore, you want to try to rotate to a smaller position as quickly as you can. I always look at it as a rule of three. I've been doing this for 20 something years with the rule of three. I think that if you're just trading one lots, it's really difficult because you can't really scale in and scale out. You're held by one price in, one price out. But with three, if you break them down into three, you are able to sell one, sell one, sell one, or sell two, sell two, sell two. And then when they rotate, you rotate out of two, and then keep your trailer. So I think that that's an important aspect, especially in the NASDAQ versus like an S&P or like a 10-year or some grain markets where you can really be a lot more aggressive at a single price because in those markets, price matters more than it does in the NASDAQ. Really look for extremes with NASDAQ because you don't think that they're going to get there, even if you want to be short, and a lot of times they do. It's going to depend on market environment. And make sure you keep an eye on cumulative delta. Order flow is so key. I know that NASDAQ doesn't have the order flow that you're going to see in the E-mini S&P, but the NASDAQ still is going to give you some clues with order flow. I think it's extremely important to watch. I do not like days to be shorting NASDAQ, even if it fits into all this other criteria, if they're building cumulative delta to the upside, because those are the days where you could just get blasted and it could, the market could just be building against you. So you have to be very cautious of that. And so cumulative delta is something that we've talked about a ton on this show, but you have to keep an eye on it, even in the NASDAQ, not just the S&P. And so that is the basic rules that I have before we even look at a chart. And I don't know if you want to discuss that, Tom, but to me, that's where I come in mindset wise before I even look at the environment.
No, I think it's great. And, as you were talking about the rule of three, I think that's so key. Rule of three really not being about three lots, right? It's really about three groups. And you mentioned the micros. So you could actually substitute three groups of three micros for almost one regular and achieve what you were trying to do, right? Which is scale in, scale out of a trade. So rules of threes is not really three lots, it's three positions. I think that's really cool.
Yeah, if there's any market that I would highly recommend scales in, it would be the NASDAQ over any other market. Russell probably would be second. S&P, I'm definitely a lot more all in a closer, tighter range, just because once again, I think that price really matters. Look at the market personality. The NASDAQ tends to find prices you never thought they'd find. Good and bad for you. So that's why I tend to really be a scaler in the NASDAQ.